Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, so it happened. The Federal Reserve did raise interest rates, and they raised interest rates by 0.5%. So 0.5%, also known as 50 basis points. So let's talk about what this is, what it means, what to pay attention to next. So this is the highest rate increase that we have seen since May of 2000. It has not, the Federal Reserve has not been this aggressive in 22 years, which says a little bit of something about history. You can kind of take whatever stance you want because, 2000, 2001, 2002 weren't all the best years for the stock market. So, it wasn't the Fed's fault? Probably not, but I'm just throwing that out there. But essentially, remember, they're raising interest rates to discourage demand, to stamp down demand, because we have inflation. We have the highest inflation we've had in 40 years, and you know why? Pandemic, stimulus, all types of stuff. And essentially what that means is you had way too much money chasing way too few goods. You ever been to a concert and it's been sold out, so everybody starts to bid? Or even shoes, this happens all the time, where you try and get shoes for, I don't know, $100, and they end up being like $1,000 on eBay because you had this many shoes and this many people trying to get those shoes. So that's how prices, just one way, how prices escalate to the highest they've been in 40 years. So the Federal Reserve says, look, I'm going to make money more expensive. I'm going to encourage people by raising interest rates to do everything else but spend at the rate they're spending. So for example, if you haven't gotten this already, I've gotten this message where my bank said, look, we are increasing your interest rates. And what that says to consumers, to some consumers, is look, well, now that I'm getting paid a little bit more, and with interest rates going up, you're going to get paid more on your savings, then hey, maybe I don't need to go out and invest everything. Maybe I can take some of this out and get a very safe and solid return in my savings account. Now, yes, you're not gonna get a whole bunch. It is not the greatest savings rate in the world. However, that is the encouragement. That's the idea. As they continuously increase rates, you're going to get more in your savings. Some people are going to take the money out of the market, put it in savings, which means they're not spending it. Okay, that is the point. They want to stamp down demand and say, look, you might not want to buy that house because now it's more expensive. Yesterday's video, I talked about the median rate for mortgages now. With this increase, the prior increase, not today's increase, is already costing $370 a month more for the median size house and the median mortgage loan. $370 more per month in interest. That tells me if I were looking for a house, which is why I bought when I did, because I didn't want to pay that extra, I was like, look, I don't want to buy a house now because it's only going to get more expensive. We are looking at 6 to 8 interest rate hikes for this year. We've only gotten 2 so far. So this is expected to continue to, again, stop inflation and reduce demand to a reasonable level so prices come back down. Because if I have 50 people trying to buy 5 things, I need to cut down on those 50 people, because supply chain, based on how we're getting and producing these goods, we haven't been able to figure that out, and we haven't been able to increase the stuff, right? We haven't been able to build enough houses fast enough to also offset prices. So because you can't build houses fast enough and make these things fast enough to satisfy demand, you've got to cut down on the demand side of things, which means that we increase interest rates, make money more expensive, and make people save more in their savings account and just take a little bit more money off the table. That is the logic here, okay? And generally it works. So what does this mean for the stock market? For the stock market, as you've seen, it's been a little rocky. Today was a good day, which tells you 2 things. Number one, this is why I wasn't trying to trade and be aggressive. I told y'all that yesterday because I didn't know which way it was going to go. And of the 3 scenarios I laid out, it was not they raise interest rates by 50 basis points, 0.5%, and the market goes up 900%. I didn't see that coming, which, hey, when I don't know and I'm not confident in that opinion, I don't trade, which I told y'all yesterday, okay? What I did and what I do and what I be telling y'all, right, is that every Friday, I'd be investing. I dollar cost average, and whatever I bought on Friday was up today, right? So that's how it works for me. And when you dollar cost average, that's one of the advantages. Is I don't have to be right on every single thing every single day. I can just be consistent, right? Every 2 weeks, every Friday, whatever schedule works for you. That's one of the reasons why you do it. So you're going to be right more often than not. The second lesson here is that remember, and I will I will try and edit this in, but remember the video I did, what, about 7-8 days ago, when I said when the market is down significantly, within about 10 days or so, the market also has a pop, and the best days are sometimes right around the corner from the worst days, and vice versa. That happened yet again. I did tell y'all, right? So you heard me say this before, that sometimes days like this, one of the worst days happens, and sometimes some of the best days are right around the corner. In fact, I've said it so many times, I actually put into a presentation that I talk about. I did several presentations last week, but like this does happen. It's been quite common, and JP Morgan has research that supports this as well. Usually within 10 to 14 business days, the best day we've had of all of 2022 is going to be around the corner. Now, I'm not going to tell you it's going to be on Wednesday or Tuesday or Monday, but stats tell us that it is around the corner, usually within the next 2 weeks or so. That don't mean that Monday's not gonna be bad either, right? But there are some things that you need to know, and things that you can learn and take with you. Again, that's why I don't buy and sell every day. It's not why I try and do all this extra stuff. I sit still, right? We understand what's going on, we sit still, and we stay consistent. This is one of the reasons as to why, okay? Now, another thing you want to pay attention to, again, 6 to 8 interest rate hikes all year is what we are expected. This does not mean that the next time we expect an interest rate hike that the market is going to snap and go up by 900 points. Again, I don't know that. I think it is relatively dangerous to expect that. So I would not say, oh, this time it was up 900 points, the next time it's going to do the same thing. I would stay away from that. I would just mind your business, continue getting the stocks that make sense right now. I'm going to go over a few of those in just a second, okay? So you want to keep all these things in mind. The entire reason we are here is because of inflation. We're trying to stop inflation, which means that the companies that you invest in, the stocks that you buy or even trade, need to have a few things in common, okay? So walk with me here on my economic journey or financial journey when we talk about evaluating companies. So the investing game in 2022 has changed. Okay, there aren't that many super high flying stocks that are up 60 and 70% like it was in 2020. Okay, it is not infrastructure stocks and travel stocks like it was in 2021. Remember that? Like Avis was one of the companies I called out, and it shot up like crazy. Now it's still up, but it's not like it was last year, okay? Every year is going to be different. And in this year, when we talk about interest rates and inflation, remember that the companies that you buy, the stocks that you buy, there's always a business component at the end. It's about making money. It's about growing. So if it's about making money, right? If it's about making money, then in a scenario where money is getting more expensive, I have to pay attention to what we call the fundamentals. That's the balance sheet. That's the income statement. That's the cash flow, the statement of cash flows. So what I mean by that, and we did a video on understanding the balance sheet, so feel free to go back and look at that one. I think that was from last Tuesday or Wednesday, if I remember correctly. But it ain't that far ago, so feel free to go back and watch that one. But in either case, it means this. If let's take a company like an Apple, right? If you are profitable, you've been making stuff, iPhones, and you've been successful in making money, do you have cash in the bank right now? Because if you do, if money is getting more expensive, that's fine for you. You've got cash in the bank, right? I don't need to go and borrow. So Apple is better off than a company, I'm just throwing one out there, like a Netflix, like a maybe a DoorDash, right? A company that just IPO'd not too long ago. Apple's got more cash in most countries, right? So Apple's fine. They got money in the bank. Interest rates can go up. Apple's gonna be fine because they got money, right? Other companies that are not profitable and have been running at a loss are not in the same boat. What do I mean by that? If your company has been losing money, like a DoorDash, maybe an Airbnb, don't quote me on that, I don't know if they're profitable or not, but if you are a business and you have been losing money, which does happen to a lot of companies, a lot of times in 2020, those companies were fine, right? They were losing money, they were still fine because people expected them to be magical. They expect them to be what we call unicorns. Think of Revlon. Revlon is one that's not doing well. They just IPO. They are currently losing money. So think of it like this, like a regular person. If you're losing money, if you're spending more money than what you have, what do you need to do? You need to borrow. Right? If you need to borrow, you are reliant on what? Interest rates. If you were relying on interest rates in 2020, when interest rates were low, you were fine. right? We're thinking you can borrow, and as long as you keep selling enough stuff, at some point you're going to break even. At some point you're going to be profitable. Well, if you have not been profitable and interest rates are going up, do you think that's going to be better for you or worse for you? It's probably going to be worse for you. So those are the companies that are really getting punished. The Revions, again, I don't know where DoorDash is, but I know DoorDash wasn't profitable at that point in time. They're probably not profitable now, but those companies are not profitable, that have to rely a lot on debt, and they are borrowing, and now those borrowing costs are getting higher. Those are the ones that are struggling the most. So in this scenario, you have to pay a lot more attention to the fundamentals. You have to pay a lot more attention to how these companies are run from a financial perspective. One way, just one way to do that is by paying attention to those financial statements, by understanding what we call the fundamentals and understanding how the businesses are making money. Are they consistently making money? Do they have cash on hand? Do they have money in the bank? Versus companies that were just, oh, they just gain more subscribers or something like that. That's not cutting it anymore. It used to. It's not cutting it anymore because interest rates are going up. Another thing to pay attention to is things like a Berkshire Hathaway. They're doing incredibly well right now. You know, one of the reasons why they're doing incredibly well? Well, at the beginning of the year, they had close to $140 billion in cash. And they took $51 billion in cash and spent it and bought stocks in Q1 of 2022. They had cash. Interest rates were going up. They're saying, hey, I got the money. I'm not sweating. In fact, I'm going to spend $51 billion and still have money left over. That's how the market is working. And that's one of the reasons why Berkshire Hathaway is up double digits in a year where, with the exception of today, the stock market had been quite terrible, with the exception of just a few. So that is what you want to pay attention to. And I keep saying it. I feel like I say it every year since 2020. What worked last year does not work this year. People are paying attention to fundamentals. This is where, and I did a video on this too, we talked about value stocks. Stocks that have money on hand, that have cash, and are still growing. That's where the market is moving. Sometimes this includes defensive stocks. Sometimes this includes dividend stocks. Sometimes this will also include REITs, real estate investment trusts. All of those things can fall into these buckets. You can also look at a value ETF. We've talked about those as well. I think VTV, so the stock symbol VTV, Victor Tango Victor. I think that's one of the ones for Vanguard, and it's doing better, or at least at the time we looked at it, I think it was doing a little bit better than what the stock market was as a whole. But that is where the market is moving. That is the theme of this year if you haven't caught on already. Look for value, look for fundamentals, and you probably want to hold for the long term. This is still a long year. We're in May, it ain't over, and we still got midterms, and we still got more interest rate hikes throughout the year. We're looking at 6 to 8. We've only had 2, okay? And the fear of recession, while today was good, is still out there. So you want to be long-term focused, be value focused, and just stay focused in general and stay consistent. That is how you're going to win in 2022, okay? The game done changed, okay? We'll worry about 2023 when we get there. But for 2022, the game has changed, okay? So you want to make sure you're putting yourselves in the best place to succeed in 2022 while also trying to put yourself in the best place to succeed for 2025. What can we do right now as an investor? You want to ask yourself, what can I do right now that's going to set me up for the next 3, 4, 5 years and beyond? Okay, that is how the market is going to work and how the market is moving. It's always moved in that way. It's just the theme always changes. It went from stay at home to value. Right, it went from travel to dividend stocks. It went from, whatever it was in 2019, it feels like it was so long ago, to, companies that have money and are more defensive and are inflation protected, right? People are talking about that way more than they ever have because inflation is so high, okay? All right, so before we end today, normally if you're new, like I do videos Monday through Friday. Y'all are going to get a video tomorrow, but it's going to be pre-recorded. I normally don't pre-record videos because we don't know what's going to happen. I don't know. I don't have a crystal ball. I don't know what's going on the day of, right? I have a list of ideas I want to talk about, but the market news takes me in directions that I do not expect. Think Tesla and Elon Musk, Twitter and Elon Musk. Do not expect that. But in either case, tomorrow Doctor Strange comes out. I am taking my tail to the movies. So I'm going to record that video today. Y'all will see it tomorrow, and y'all will catch a fresh video on Friday when I record it on Friday. Okay? No spoilers. I ain't gonna say nothing. So you are safe here on this here channel. But I can't speak for other channels that cover movies. All right, so that's it for me. Like, subscribe, leave a comment. I'll talk to y'all tomorrow and today, because I also gonna be in the comments, but I'm gonna just be at the movies. All right, y'all. I'll talk to y'all later. Bye.